Hi everyone. Today let's talk about GE. It's been a while since I've talked about GE, a little bit over a month to be specific, but I still plan to wheel this stock as long as I can before they potentially do a stock reverse split. So I'll start off by going over the earnings announcement, then we'll take a look at the technical analysis, then I'll go over my current position in GE, and then I'll finish up with my position tracker. If you like trading stocks and options and making money, definitely like and subscribe. I do videos like this and full portfolio overviews every single week, so definitely hit the bell so you don't miss out on any future content. Welcome to the Portfolio Bulletin. Let's get started. So starting with these earnings, overall they were basically mediocre. The stock declined a little bit after their earnings announcement, and they mention here this was based on a revenue decline, some pretty small profits, and a large quarterly cash burn. However, they say the stock is still on track for its long-term recovery, which is really what we want to see for long-term investors. GE revenue slumped by 12% down to $17.1 billion, and the industrial section fell by 10% to $16 billion, driven by a 27% organic revenue decline in the aviation sector. This is important because the aviation sector is definitely their strongest part of their business, but it was obvious that this was going to happen due to the Rona. They did manage to squeak out a small profit of 3 cents per share, and they burned $845 million in cash during this quarter. The power and renewable section also lost money during this quarter, and to me it was expected that the renewable section was going to need more time to be profitable because they've been selling things at below cost in order to get the business going, and they've been raising their margins on that section over time to build it into a profitable portion of their business. Now for some of the positives, they say first, 3 of GE's businesses improved their profit margins on a year-over-year basis, which includes power and renewables even though they lost money. They say the first quarter tends to be a little bit weaker than the fourth quarter, and it's generally their weakest quarter of the year. GE Aviation returned a solid 12.18% margin despite only generating $5 billion in revenue, down $8 billion from the year prior. Obviously, they have a ways to go before they reach pre-Rona levels, but when they get back there, they should enjoy over 20% operating margins. And with the way the economy is reopening right now, it makes sense that they will get back to 20%. They also continued to pay down their debts. They only borrowed $4 billion this quarter, reducing their total borrowings down to $71.4 billion, which is obviously a huge number, but just 2 years prior, it was $107.5 billion, and they are expected to continue to pay down this debt aggressively. In second quarter, they plan to sell their portion of Baker Hughes and get around $1 billion for that sale, and they are also selling their aircraft leasing section to AeroCap, which is something I mentioned in a previous video, which will generate $31 billion, including $24 billion in cash, which GE plans to use for additional debt repayments. So in summary, the quarter did not look great, but the company is still on track for a solid recovery in the years to come. Moving over to the technical analysis, you can see we've been in this up channel for quite a while until we broke out here in February, making the most recent highs here in March, and we've kind of down channeled slightly since then, breaking just below the 50% mark on the RSI, indicating a potential move into a bearish trend. MACD also shows an acceleration to the downside, and stochastics are right here in the middle, not pointing in either direction. The technicals don't matter too much to me since I'm planning to wheel this right now, but it's good to see that we're basically moving sideways, which is fine for me as an option seller. Moving over here to the 4-hour chart, you can see that channel a little bit more clearly, and we've definitely broken to the downside here on the RSI, well below that 50 level, sitting around 41. But if you look back here to April 20th, you can see we had a much lower rating on the RSI, and we are slightly above that in price, but we are much stronger here on RSI, which means there's certainly potential for a move upwards. MACD is slowing down here to the downside, and stochastics are showing oversold, which potentially means a buying opportunity. If we find a floor right here and we move back up to this previous trend line, it seems to me that we could find some support and move up to this $14 level. Of course, there's always potential that this could break down right here, and we could retest this lower level, or even go back into this previous channel, representing a price target of around $11.80 to the downside. Taking a look at my current position, you can see I've sold the $13.50 puts and bought the $11.50 puts, putting $2 at risk, but I did receive a 41-cent credit here, putting my break even at $13.09 and effectively putting $1.59 at risk. I must have gotten a terrible entry here on April 26th, only getting a 41 cents credit, which was only available for a very short time here right at the open and here in the midday. And if I had just waited a little bit, I could have gotten probably around 49 or 50 cents. And certainly the next day I could have gotten much higher prices. But that isn't the wheel strategy. You're not really supposed to time your entry. You're supposed to spend more time in the market, allowing the extrinsic value of these options to expire and collect small credits in order to reduce your cost basis. Something I also want to mention here is that I still have the $9.50 puts from my previous position. And this is because there is just no bid for them. So I closed the $12.50 put that I had previously, and then I'm left with this put, which is going to expire out of the money. I've been trying to sell it for $1 every single day, and it's just too far out of the money, and GE does not have enough volatility to even sell this for $1. So the lesson here is, if you're having a hard time getting out of a position because one of the options is too far out of the money and you can't close them together as a package, just close the option that's giving you the risk. Usually you can just close the position that's giving you risk, and you'll just be left with this buy option, which in this case is most likely going to expire out of the money. In terms of a little bit of strategy here for GE, if the stock does continue to go down, I can always roll down the puts that I bought in order to collect a larger credit. Of course, this does open me up to more risk, but like I said, I'm only risking $1.60 here, and I would be open to rolling this down in order to collect more credit, especially if your plan is to wheel into the stock. This is just a way to further reduce your cost basis slowly over time before eventually being assigned. Moving over to my tracker here, you can see the two positions. I closed out the previous $12.50 put for 5 cents, and I opened the next put here for 41 cents, reducing my cost basis down to $11.52, which you can see is right at my protection level, $11.50. And I've received almost $2 in credit, so I'm officially playing with house money in the fact that I don't even have $2 full at risk. So even if the stock drops below $11.50 at expiration, I will still have some profits. Moving over here, you can see my close date is now at the 4 June expiration, which means at expiration, I will have traded this stock for almost half a year, which if these profits continue to be sustainable, I will realize around a 233% gain. This is based on the fact that I have $2 at risk, and I've generated almost $2 in credit so far before the half-year mark. So if I can generate another $2 in credit before the end of the year while maintaining $2 at risk, that means I generate $4 based on $2 of risk, representing that over 200% gain. Of course, as I mentioned in my previous video, I don't plan to wheel this stock. Once they do their reverse split, if that does get passed in their next vote, that will increase the stock price to over $100, and I don't intend to hold $10,000 worth of this stock. So I'll probably choose a new smaller stock to continue this year-long wheeling strategy, maybe something like Ford. But if you got any value out of this video, definitely like and subscribe. Hit the bell so you don't miss out on any of my future stock videos or portfolio overviews. Of course, none of this is financial advice. This is all for entertainment purposes, and have a great day.